My name's Worth Wray. I'm the chief strategist for John Mauldin, which extends across Mauldin Economics and his various companies. Wake up every morning trying to better understand what's happening in the world, what's changing, and frankly, what's the same, what hasn't gone away. We've been looking and telling the same story for quite a while, and it's fascinating to see that the world has followed kind of cleanly along a script. What we've seen is, this debt drama begin to play out, where huge amounts of capital started to flow into the wrong places. Huge amounts of credit started to build up across the system. It took 30 years, but toward the end of that, it spilled over into a massive private sector credit crisis. And what's fascinating is that if you look across the generations over 500, 600, 700 years of financial data, whatever we have, it tells us that these things kind of follow a path like a 3-act play. First, you get the private sector credit crunch and a real crisis that sort of bubbles over. It can get really ugly. It's what we saw in 2008. It's what we saw in 1929 with the Great Depression. We've seen it time and again. What's fascinating is when governments step in, they can become the saviors. No one believes they can at the time, but they step in, they ramp up fiscal spending, they encourage central bankers to monetize the debt where they can, and for a while, everything is good. It's like what we saw in the middle of the 1930s, where, I think a lot of people don't realize it, but GDP growth actually rebounded in between in the mid-1930s. Unemployment came down a bit in the 1930s. The stock market was up 300%. People thought they were out of the woods and then it was all rosy. This is this period of time where governments are the saviors and everything looks good. But eventually, governments become the problem. And we're getting into that phase right now. It's fascinating because we've seen it in Europe and we've seen it in Japan just a little sooner. But this is all one road. It all leads to the same place. So we've been telling the same story for quite a while, but today we're starting to see it morph, and we're starting to get further down the road. We're starting to understand what we might actually have to deal with. I'm not sure which shoe drops next, and that's why it's so important to manage risk first and foremost. When we're thinking about the investment process, we have to approach this as managing uncertainty, and we have to accept and embrace the fact that we have no idea what's playing out. The important thing to keep in mind is that the global system itself is so highly leveraged and so inherently fragile. It looks like it's been quite strong. Central bankers have been pumping money in like crazy. Governments have really exhausted and been testing their own balance sheets, trying to give as much support as they have. And to be honest, in the United States, things are about as good as we possibly could have expected, and maybe a little better. That's not a great thing now that we're looking back on it. We don't have a ton of buffers to deal with the next crisis. In Europe, you've seen a depression that is worse than the 1930s. People are starting to call it the Greater Depression. There's a decent portion, or there's a significant portion of Eurozone members who are nowhere near their pre-crisis peaks. They're not even above it. France and Germany are above it, but they're starting to roll over and starting to look pretty weak. There is significant risk still that the Eurozone can implode, and that for non-economic political reasons, this can still come apart. Eventually, it comes down to a question of who is willing to pay. Is Germany willing to pay the cost of a full unification? I don't think they are. And I think that by delaying that decision, we're going to find out, but by delaying that decision, they've gained quite considerably from the sort of inherent structural competitive imbalance that benefits them. But the Eurozone can still come apart. Any sort of unannounced exit, I think that there's plenty of reason to believe that France may be forced to leave the Eurozone. I don't think the French have the stomach that we've seen from Spain, that we think we might see from Italy. There's a lot of incentive for France to get to that point that if the Germans won't cooperate and bear some of the strain as well, if the French actually think they can pull out, this could get very ugly. And the funny thing is, when we look at this kind of instability, the shock comes when we least expect it. The shock comes when we are, as a market, quite complacent, not paying attention, not thinking the risks are really there anymore. But I can tell you, the economic condition continues to deteriorate. The risks continue to rise, even as sovereign bond yields are falling. So we have to look at this in terms of where the instability is not being acknowledged by the market. Europe is still a very big risk. We could see a shoe drop there tomorrow, or it might be another 5 years. The longer you go, the more France and Italy and maybe even Spain continue to deteriorate, the closer we get to a shoe actually dropping. China looks like a tremendous crisis sort of in the making. And it's interesting because whenever I bring up China, people want to focus on the fact that it has substantial buffers to protect itself in time of crisis. And, maybe we should back up and look at sort of the history of credit booms. Several researchers from the IMF recently put out a report. They've updated it a couple times in the past couple of years, looking at the history of credit booms in the modern era over the last 50 years. What we know is that there are 4 times in history in the past 50 years where in any country, anywhere in the world, has seen lending growth anywhere in the neighborhood of China's in the last 5 years. China's total social financing numbers are up in the neighborhood of 73% over the last 5 years. In the 4 other instances of comparable credit growth, all of them ended in hard landings. And here's the kicker: within 3 years of the credit boom cooling. And it followed a very particular pattern. If you look at the archetypical credit boom pattern, China's total social financing, the line itself, if you look at the graph, looks like it is just stenciled out exactly to meet the archetypical pattern. More importantly, we are in the 2nd year of cooling. We're advanced in that cooling stage. We're in that danger zone for China, where it's not that deleveraging has to occur. It's that credit growth has to just fall back to its median level to start having real and profound impacts. And it's interesting because the actual economic numbers, actual debt figures that you see in China are the deepest and darkest state secrets that the Chinese have. We will never know how high their total debt to GDP is. We will never know what their NPLs are unless it boils over into a real crisis and those numbers come out after. And I think we may figure out what those numbers are. Right now, it depends on who you talk to, but China's total debt to GDP across public and private sectors are in between 200 and say 400%. It's ultimately a function of, is their GDP accurate? Are their debt numbers accurate? Who knows? The point is, we don't know. And neither did the Chinese leaders. This is something that is one of the best kept secrets in macro land right now. But when we look at China, we see sort of the most opaque area in the world in terms of major economies, where it's totally unknowable. People talk about shadow lending and not knowing what happens there. The entire country is in a shadow right now. You can look at total debt to GDP numbers, like I said, in between 200 and 400%. If it's 250%, if it's 300, if it's 350%, these are big numbers. But what's more important is the more recent pattern in their credit growth. They've ramped up growth after 2008 in lending, and you've seen sort of total social financing peak well over 25% a year. It's up to 30% a year at one point. Now that it's starting to cool, you've got the big 4 banks in China, which banking assets to GDP are all over 25%. ICBC, the biggest bank in China, almost has 40% total assets, banking assets to GDP, which, by the way, Lehman Brothers in the United States before the 2008 crisis, it was 5% of banking assets to GDP in the United States. So what we know is that the top 10 banks in China pose a bigger systemic risk within China than Lehman did in 2008, and that the big four banks are 5 times that, if not more. Now, people say, okay, great. Banking assets to GDP are very large, but China's not, the same mature credit system. They still have a fairly immature credit culture. The actual, debt to equity ratios look very low. The fact that the debt to equity ratios look so low and meaningful is based on assumptions that non-performing loans are at about 1%. That is shocking. If you look, for example, at China Development Bank with sub 1% NPL readings, with all sorts of loans to Chinese state-owned enterprises, to Central Asian kleptocrats, to at least oil companies that simply, you look at these debts and you tell me if it reflects a 1% NPL rate. And what this actually reveals is that the same thing that you saw in the 1980s and in the 1990s with Japan, where they were significantly underreporting their bad debts, intentionally classifying them as something that they weren't. People don't realize that a non-performing loan is a technical term in China. It's a legal term within China, and it's based on a 5-number sort of tier or 5-tier ranking system. All you have to do is classify 1 as a 2, and a 2 as a 3, and a 3 as a 4 to suddenly have your banking system look solvent and look good. What we know, though, is that you can maintain and roll bad debts, prevent them from showing up as non-performing loans, prevent them from showing up as bad debts in the system, as long as you can keep the banking system itself from collapsing, from starting to realize losses. What the Chinese have to do is somehow manage to deleverage the system because it is a ticking time bomb. Deleverage the system, and the only way they can do that is by buying time, by rolling over their debts, and by slowly disposing of the worst debts. And the problem is they add up. If we look into what those numbers could actually be, again, these are the deepest and darkest secrets that Beijing has to hide. These are as sensitive as its greatest military secrets. What the true NPL numbers are actually could be the crux. It could be the cross that China itself is crucified on. When we think of what is brewing and hiding within China's banks, this is the biggest risk that I see in the world. We don't know what these numbers look like, but if NPLs were not 1%, but 4%, or 5%, or 10, or 15, maybe even 20%, if suddenly China's banks were so insolvent that even the Chinese government did not have the resources to keep a lid on it, that's where this gets ugly. And it's funny because if you look in the pattern, typical pattern of credit booms and credit cooling, this is where those numbers start to be realized. This is where property starts to cool off, holes start to be exposed in a banking system. It's where you're starting to see commodity stockpiles building up, which, by the way, the commodity stockpiles that are claimed multiple times as collateral within the banking system, if we actually have to unwind the Chinese banking system and unwind its collateral web, realize what loans are based on true numbers, suddenly we start to realize that the Chinese banking system is absolutely insolvent, which makes it a liability of the Chinese government. And the question becomes, can the Chinese government bail that banking system out? Can the Chinese government keep the Chinese economy growing to a point that these losses don't have to be realized? Because ultimately, even though they have $4 trillion of FX reserves stockpiled and built up in that neighborhood, it may not be enough to prevent capital flight. We have an over-leveraged global economic system that has sort of reached the end of its growth model globally. The entire global economy needs to be restructured. The way that countries fit together on an international trade basis, the way that a lot of major countries in the world derive and drive their growth over time needs to be revisited, restructured in order for this to keep going. What we know is whenever we reach these periods, it usually isn't, the economics usually aren't allowed to play out to their logical conclusion because there's military intervention before you get there. Listen, this is the interesting thing. There is tremendous opportunity out there. I'll give you one example. It's robotics and artificial intelligence. Some of the new technology that we're seeing is incredibly capable. It also has a dark side. But what we're seeing, for example, that advanced robotics is at sort of its inflection point. We've seen robotics become increasingly capable over the course of the last 20, 30 years, but it was really only cost effective within the auto industry. What we're starting to see is general purpose robotics that are becoming very cheap and very useful that can be, we're seeing general purpose robotics that are not only increasingly cheap and increasingly useful, but increasingly able to learn and adapt. They can be taught. They can substitute, or their advanced robotics can be substituted for human labor in a way that we've never seen before. People say that we've seen, sort of increasing technology, or increasingly capable technology that's been able to amplify the value of human labor. But what we're seeing now is technology that's actually able to replace human workers. That's a great thing. It means that we're able to produce great abundance and free up human muscles and perhaps even human minds in a way that we've never been able to do before. That frees up humans to do what we were created to do, which is to create and to build and to innovate. It could be an enormous lift to living standards over a long course of time, but we're going through this transition period as well. The investing process is all about managing uncertainty. That over time, over the course of human history, optimists have always triumphed. Optimists have always won out. Economic growth has always come through. Innovation has always driven higher living standards, has driven higher earnings in companies. That's over a very long period, though. We know that over very long periods, stocks tend to outperform every other asset class, significantly outperforming other things like gold or fixed income or real estate. The trouble with this is that you go through profound periods of adjustment where you might have a strong, true, organic growth story that gets overbought and oversold, and suddenly you're in a position where the market needs to see extraordinary earnings just to continue pricing at its current level. I think we've reached that point. It's what we saw during the tech bubble, and it's interesting because right now faith in central bankers is, back up. See, today faith in central bankers is exactly what faith in the internet was like in 1999. This is overstretched. It's very true that central bankers have been able to shore up the system. It's also true that it's hollowed out the middle class. It's true that it's increased inequality. Definitely seen certain areas supported and driven, and the stock market has continued to run. But how much longer can a stock market continue to run when valuations are so high, when valuations are so stretched, in a zero interest rate environment that looks like it may be coming to an end? I don't know if a lot of people have noticed, but the labor market is getting tighter. Growth has been surprisingly strong here in the U.S. Things have been good, and it's getting harder to justify that. If we stay invested in growth-oriented portfolios, if we continue to invest in the traditional framework where 90% of the risk and 60% of the dollar allocation is left in the stock market, just sort of blind, unhindered, this can leave us open to tremendous risk. What we have to start doing is migrating a portfolio away from simply stocks and bonds into something that's far more balanced, that's far more risk managed. One of the things that we can look at is technical factors, things like momentum. My friend Meb Faber has done tremendous work on asset allocation models that work off of the 200-day moving average. When the 200-day moving average is sort of your cutoff point, when the markets are above a 200-day moving average, that's a time that you generally want to be invested. When you fall below the 200-day moving average, especially when you do that in a hard, sort of swift way, that can be a very dangerous place to be invested. And so identifying when does it make sense to be invested, And when it does, how do we deploy a portfolio in that sense? And when are the times when we don't want to be invested? We have to be thinking intentionally about managing the risks we cannot foresee. That's the point that I'd want to make. That in an environment where there is profound opportunity, where there's opportunity in private investments, where there's opportunity in advanced technology like robotics and artificial intelligence, where there's opportunities here in the United States, there's opportunities in things like European telecoms, there's opportunities in even Chinese growth equity companies. It's just a question of at what price does it make sense? At what valuations does it make sense? Can valuations be sustained if the macro picture is to get disrupted? And then if we look from a global perspective at all the places where a shock could legitimately emanate from, and we look at and we wonder how it could happen, even when we can identify the imbalances, it is very, very difficult to get the timing right. I know brilliant investors who have identified imbalances years in advance and struggled and frankly blown or risked their reputations in the process trying to get the timing down. It's almost impossible to know. But what I can tell you is that over the course of the next 5 or 10 years, even though the stock market may continue to run, it may collapse. It doesn't have to. There's a wide range of possible economic scenarios, from a deflationary meltdown and paying the cost of all this misallocated capital to an inflationary run where the labor market gets tight. Suddenly labor has, shockingly in the era where capital is gaining so much favor, labor actually has bargaining power and is able to push us through into an inflationary cycle. This is a wide range. And so what I'm saying is, from an investment perspective, we have to build portfolios that are ready for all of that. It's not an easy thing to do, and it's not something that most investors are prepared for. If you look on financial media like CNBC and Bloomberg and follow sort of the methodology, one of the things you'll see is that most investors are encouraged to focus in precisely the wrong places. People want to focus on outperforming a market when they have no discernible edge or reason to believe that they can outperform or outsmart market. One of the things that we see is, and in my sort of personal experience working with hedge fund managers and private equity managers around the world, I've seen that there is a very small number of people that take most of the outperformance in the market over time. And that if you think of the market as a big, Wall Street is a big selling machine, of the market as frankly a casino. You have people coming to the poker table every day who want to bet their life savings on no discernible edge. And there are plenty of people sitting at the table who are willing to take that money away from them. If rather, instead of focusing on trying to outperform the market, if we focus on trying to get better exposure to the markets with an emphasis on very tight risk management, not only can we dramatically outperform the average investor, which makes people feel good, but we can dramatically improve our investment experience and get the full potential that those markets offer without opening ourselves up or exposing our flank in a way that we will pay dearly if we're wrong.